Welcome to the second edition of Capital Considered. We're delighted to have Brett Arends, our old friend, as our guest. Brett began his writing career at TheStreet.com. Before that, Brett, I think you were an analyst at McKinsey, and after the Street,
I was.
Yeah, after TheStreet.com, you moved to the Boston Herald before TheStreet.com. Isn't that right?
Yeah, I mean, actually, if you go back far enough, I was at the Daily Mail in London.
Okay, that's right.
That's where I really started
Yeah.
my journalistic career, anyway.
Yeah. And then Dow Jones, of course, you for a brief time you were the columnist along with Jason Zweig at the Weekend Journal when I thought it was at its best. The editors probably won't care if they hear this and hear me say that, but and you've been at MarketWatch now for a good long time since then.
So long.
Yes.
I was actually just digging out an old company headshot for something, and I realized it was from 2011. Fortunately, I don't seem to have aged as much as I might have done in those 13 years. I don't know whether it's a bit of a Dorian Gray situation. I'm aging on the inside, but anyway, there we go.
There we go. So you've been writing. You're the retirement. You are one of the retirement columnists for MarketWatch. You write about retirement topics, investments, but all kinds of other topics as well related to retirement. Let's start with an investment topic because we've been writing about it lately. You and I have been talking about it privately. TIPS. Explain to the audience what is a TIPS bond? What is a TIPS security? Why does it look attractive now?
It's funny. Yeah, you and I have talked about this offline. It's a subject to which I'm becoming alarmingly obsessed. TIPS are surprisingly underappreciated or underreported or understood. I say surprisingly because essentially they are the risk-free asset. TIPS bond is a bond issued by the United States government, which operates like a treasury bond. It is a treasury bond, but with one difference, which is that the value is adjusted to reflect changes in inflation, basically the consumer price index. It's an inflation-protected treasury bond. What this means is that your payments, present and future payments, are guaranteed not only in dollar terms, but in purchasing power terms. So you are absolutely guaranteed to earn a fixed amount of money over and above the inflation rate, whatever the inflation rate turns out to be.
Yeah.
So, I mean, the thing is, we don't eat nominal dollars. We eat real dollars.
Yeah.
As people found out when inflation took off in 2021, 2022, they suddenly discovered that, prices go up a long way. If you don't have payments that reflect that, if your payments don't rise or the value of your assets don't rise to reflect that, then you're just falling behind. I mean, we saw this, we've only seen a brief surge in inflation so far, but those of us who are old enough to remember the 1970s remember sustained inflation. In fact, it ran well into the 80s. And the very low rates of inflation that became normal in the millennium were unusual back then. And people who were on fixed incomes back in the 70s were in desperate trouble because essentially prices went up 10% a year and their income did not. And so they just lost money. They basically, in real terms, they lost money. So TIPS are inflation-protected treasury bonds which adjust. It's complicated. It's so complicated that even experts, there are actually very few experts on the subject, and even the people who are experts tell me privately, I'm an expert, but even I don't really understand it. The value of the principal, of the face value of the bond adjusts to reflect the consumer price index, and then the interest rate is applied, the coupon rate is applied to that face value. It's very complicated.
The new face value,
Yeah, it's complicated. The bottom line is they are treasury bonds that are adjusted to reflect inflation. They compensate for inflation. And therefore, TIPS bonds are actually the real risk-free asset, not nominal treasuries. People talk about nominal treasuries because nominal treasuries have been around for much longer and because it's a much bigger market. But actually, for me, the most interesting question of the day isn't what is the interest rate on the nominal, the regular 10-year treasury bond. The thing I first look at pretty much every morning is what is the real return on TIPS bonds, which is to say, what are TIPS bonds paying over and above inflation? What is their real rate of interest? Real in the economic sense, meaning post-inflation. In economics, finance, people talk about real returns and nominal returns. A nominal return, if inflation is 10% and you make your stocks go up 10%, your nominal return is 10%, but your real return is 0.
Yeah.
So what really matters is the real return. But
Yeah.
actually, what's very interesting is when people talk about movements in the 10-year Treasury bond, I'm much more interested in what's happening in the TIPS bonds, because that essentially tries to filter out inflation. And what has been very interesting to me lately, and the thing you and I have been talking about offline, which I'm very happy now to talk about online, is that the real returns, the real rate of interest on TIPS bonds has been rising and rising dramatically in recent weeks. And I'm trying to understand why that would be, what rational reason that would be. And there are a number of possible explanations. Nobody knows for certain. It's, as usual with finance, nobody really knows till afterwards. I think it was Fred Schwed who wrote the best book ever written about Wall Street, entitled "Where Are the Customers' Yachts?"
Yes.
Who said Wall Street is full of people who have never been wrong once in retrospect, or never been wrong once in hindsight. Oh yeah, I expect it. The next time there's a stock market slump, all sorts of people who did not anticipate it and did not get out of stocks will say, "Oh yeah, I was expecting this. It's a healthy correction." So anyway, so nobody really understands, but there are a number of possible explanations for why the real interest rate on TIPS bonds has risen so much. To give you an illustration, first of all, of what we're talking about, the real return now on the long-term TIPS bonds is well over 2%, and at the very long end, the 30-year TIPS bond is 2.5, 2.6%. So that means that if you buy this, if you buy buy the 2054, the 30-year TIPS bond, you buy it today and you hold it for 30 years in a tax sheltered IRA, a tax sheltered account, so we'll remove taxes from the equation. You are guaranteed that by 2054, your investment will have grown by 2.6% per year over and above the rate of inflation.
Over and above inflation, yeah.
So you will have, whatever that 1.026 to the power of 30, whatever that is, you'll be, whatever it is, 50% richer or whatever in real times. You'll be able to buy 50% more apples, 50% more potatoes, 50% more iPhones, 50% more, get 50% more haircuts, whatever.
Right.
In 2054 than you could get with the same money now.
Yeah.
No matter what happens to inflation. One of the interesting things I was looking at is bringing it much nearer term. There are April 2029 TIPS bonds, so they mature just after Donald Trump is due to leave the White House.
Yeah.
And they are paying just over 2% real, in other words, 2% above the inflation rate. So in other words, if you were full of gloom and doom about Donald Trump being president and you wanted to sit out the entire Trump administration with zero actual risk, you could put all your money in the April 2029 TIPS bonds. Again, if you use a tax shelter, it makes a lot of benefit. And when Donald Trump leaves office, you will be able to buy 8% more potatoes and haircuts and iPhones than you could now. That will be your compensation for waiting for 4 years for your money. It will be whatever inflation comes in. If it comes in at 0%, 2%, 10%, 50%, whatever, you'll get that plus 2%, 2.1% over the course. I'm not saying people should do this. I'm just saying it's interesting because that's actually one of the numbers I look at. And it's what I find fascinating. You and I are two of a very small number of people who even talk about TIPS.
Yeah.
And I find it very odd because it is the single most important number, really. It is more important than the yield on the nominal treasury.
Sure.
So, for example, that figure tells you, that is a sort of baseline of what you can expect from the Trump administration. If you are taking on risk, in your portfolio for the next 4 years, you have to ask yourself, am I going to beat inflation over the next 4 years by at least 2%?
Yeah. And just to
you could just basically buy the bond and then, go to the beach.
That's right. And just to recap for investors, the basic problem with nominal bonds or just regular plain bonds is that they offer a fixed rate of return, and if inflation starts to exceed that, then you're losing purchasing power. And so the kind of magical thing about a TIPS bond is that it keeps up with inflation. It keeps up with CPI.
Nominal bonds are a lie. Nominal bonds are grossly misleading. They say, you're going to get 4.5% over the next 10 years. Well, you'll get that nominally, but what does that mean? That is a totally meaningless figure because you don't know what's going to happen to prices.
Yeah.
If prices go up by 5% over the next over the next 10 years, you've lost money. You are going to be poorer 10 years from now than you are now. It's insane. So nominal treasuries, nominal bonds are very misleading.
Yeah.
And it is bizarre. It's a convention that people sort of focus, and people in finance focus on nominal bonds.
Yeah.
And when I try and have conversations with people about tips, their eyes glaze over.
Yeah.
I wrote something about tips just recently. I got a couple of emails from people saying, "Oh, they've been terrible since 2022." The interesting thing about tips is because they are bonds and because they trade. These are not like I bonds, which are sort of safety deposit accounts run by the federal government. Because they are bonds and they trade, the real return that you get on your bond is going to be different depending on the price of the bond. So when if tips bonds fall in price, bonds are always like seesaws. So if the price goes down, the yield goes up, and if the yield goes down, so if the price falls, then the real yield goes up, and vice versa. Now, if you go back 3 or 4 years, tips bonds were so expensive in the market that the real yield, the post-inflation yield, was negative. You were guaranteed to lose money in real purchasing power if you held the bond to maturity. Now, to me, that makes almost no sense. I mean, some people said, it's protection in case inflation gets, if we get Zimbabwe levels of inflation, everything collapses. At least in a tips bond, you're only going to lose 2% a year or whatever. 1%. All right, I can understand that. But as a general rule, why would you own an asset that has a negative real yield? And when tips bonds have a negative real yield, the people come out of the woodwork, as always on Wall Street, to explain why this is perfectly rational and it's not an obvious sell signal. Now that tips bonds have very large positive real yields, people come out of the woodwork and say, oh, that's perfectly rational. The main argument being made at the moment is that tips bonds and nominal bonds are all falling and interest rates are rising, both real rates and nominal rates, because the bond market is anticipating a massive amount of new bonds being issued because the bond market thinks Donald Trump, when he is president, is going to slash taxes, increase spending, and run up deficits vastly higher than anything we've seen before, that there's going to be the federal government is going to need to borrow just gigantic amounts of money that will increase the supply of bonds. The IOUs that the federal government has to hand out will just go up dramatically, and therefore the bond market is saying, well, supply has gone up faster than demand, so we're going to demand a better price. So essentially, bonds are selling off because the bond market thinks many more of them are coming down the pipeline, and that we're entering an era when interest rates, real interest rates as well as nominal interest, are going to be much higher. The federal government is going to have to pay much higher rates of interest to borrow money than it has in the past. That's, in other words, we're at an inflection point. We're at a structural change, and when you look at the deficit figures, they are horrendous, and we have there has been this bizarre idea that because we haven't had a deficit crisis yet, we won't have one in the future. As more than one person has pointed out, if just was the path to prosperity, Zimbabwe would be the richest country in the world, and it isn't. So at some level, you reach you reach a limit, and the amount that the government has to borrow becomes so huge that it affects interest rates dramatically. We're going to see where we are living through history. We're going to see what happens. The entire world depends upon the U.S. federal government and is dependent upon the U.S. Treasury market. The U.S. Treasury market is the price of is the fundamental interest rate for financial markets. So if the yield on 10-year or long-year Treasury bonds and tips goes up, then the cost of capital for everyone from corporates to municipals goes up to foreign governments, and that in turn will affect the stock market badly.
So that's the case for tips now, but they were trading with negative. You were locking in a loss if you bought these things in 2021, 2022, and now you're locking in inflation plus a gain, and in some cases a very healthy gain.
That's exactly right. I mean, the highest tips have only been around since the late 1990s, so it's a limited history with tips. And crucially, they were not around during the 60s and 70s and 80s, the time of hyperinflation. They were actually created first in Britain. They're called linkers, index-linked.
That's right.
They were actually first created by the British in the early 80s because a lot of after the great inflation of the 60s and 70s, a lot of fund managers said, look, went to the government and said, look, we would actually, our liabilities are in real terms, and we would like you to create these products. So America didn't create them until the late 1990s, and as a result, they have not really existed during a period of sustained inflation. So we don't actually know what will happen to tips if we get a period like the 1970s when inflation is embedded and seems to be out of control. But since the late 1990s, the real yield on tips has fluctuated depending on the circumstances. They started out incredibly high. They started out over 3%. And they were 3% in the late 90s when everybody just wanted the stock market, and they wanted stocks and they wanted growth. Then when the bear market kicked in the millennium, the real yield of tips basically went up in price and the real yield went down. And for most of the past 24 years, the real yields have been well below 2%, often below 1%, sometimes below 0. In fact, a few years ago, I had a tips expert, a tips fund manager, saying when the real yields were like 0.4%, he said, I don't think we'll ever see real yields above 1% again. Of course, now we're at 2.5, 2 to 2.5. Now, 2 to 2.5 isn't as high as the peak levels we saw in the late 90s and very briefly during the financial crisis. In the fall of 2008, there was a liquidation panic. It was a fire sale, and all the banks had to sell off everything liquid. So tips tanked for about 3 weeks, late November, and the real yields went up to 3%, in some cases even more. But that was a very brief moment. Apart from those two periods, real yields have typically been anywhere between 0 and 1.5, 1, whatever. 2.5 is very good. It's not extraordinary. Extraordinary would be over 3. Because we don't have a long history about tips, I've gone back and crunched the numbers on nominal treasury bonds. And I looked at what you would have got if you had bought nominal treasury bonds, going back to the 1920s. If you bought nominal 10-year U.S. treasury bonds, and you'd held them for 10 years, and you deducted the inflation that you'd experienced during that time, what would you have earned in real terms over that 10-year period? And actually, the median was less than, I think, 1%, and the mean, the average was, I think, about 1.5, 1.6%. Averages, the straight average, the mean is usually much higher than the median because the straight average reflects some very high numbers. It's like Bill Gates and I have an average net worth of $100 billion. Median is when you basically line everybody up from the shortest to the tallest, and you take the one in the middle.
That's right.
And it's usually it's a quicker way of avoiding the distortions caused by outliers. So essentially, typically people have ended up with somewhere between about 0.8 and 1.6% a year above inflation, and currently long tips are offering 2 to 2.5. Now, what's interesting is I think it was Ray Dalio who was writing about this a while ago, and he made a fundamental mistake. He was comparing, he was looking at tips and nominals and all the rest of it, and he said he expected nominal yields to, real yields to settle around, on the long end, settle around 2.5%, which would be where they are now on the long tips. And his argument was that was based on the history of nominals. However, there's a couple of problems. First of all, that doesn't actually reflect history because, as I've said, the the actual average, the median or the mean, the average is somewhere between 0.8 and 1.6.
Yeah.
Second of all, and this is the critical issue, second of all, people who bought nominal treasuries were taking on inflation risk. When you bought a treasury bond in the past, let's say you bought a 10-year treasury bond paying 4% nominal,
Yeah.
you're gambling on what inflation is going to be over 10
Yeah.
years. And because you're taking on inflation risk, you are going to expect, the market is going to expect to be compensated for that risk. For the same
Sure.
reason you get compensated for stock, volatility risk in the stock market.
Yeah.
So you would expect the real yield that people got owning nominal treasury bonds to actually be higher on
Yes.
average than it would be on tips, because with tips you are not taking on any inflation risk.
That's right.
You're guaranteed to get whatever you're going to get, inflation plus whatever.
Yeah.
So the 10-year right now, the 10-year tips bond, I don't think there is technically a 10-year, but the closest to it is just over 2. I think it's 2.1%.
Yeah.
So, or maybe 2.2%. So it's 2%, let's call it 2.2% real. So you are guaranteed to get inflation plus 2.2% over 9.5, whatever it is, 9.5 years.
Yeah, provided you hold it
you're-
to maturity. Sure.
Provided you hold it to maturity. So there is no inflation risk in that asset.
Yeah.
So-
Whereas if you buy a 10-year nominal right
Yeah.
now, you get 4.6, which is beating current inflation, but
Yeah.
you have no clue if it'll beat future inflation, and you're holding it for 10
right.
years.
Exactly right. And because of the time value of money, if you get a high spike of inflation in the first couple of years, that's going to have an outsized effect on your total return on that nominal. So I would not. So if a TIPS bond offers a guaranteed real post-inflation return that is higher than the average real post-inflation return earned in the past by regular nominal treasuries,
Nominals,
I
yeah.
would call that a deal, because
Sure.
essentially you
Yeah.
are getting a higher return and no risk. Now,
Yeah.
there have been occasions when people have bought nominals and they have made an absolute fortune, because the best time ever to buy nominal treasury bonds was in 1982.
Sure.
Because after 20 years of inflation, the Fed had raised interest rates very high to 15%, and you could get 30-year treasury bonds yielding about 15%.
Yeah.
And if you bought them then and you held them, you made an absolute fortune, because inflation collapsed and you weren't locked into a real yield. You were locked in. So essentially you got 15. So the long and short is you made some ridiculous sum of money. And actually, I think you may even have made more money on treasuries. Certainly for a certain period, you made more money than you even did on stocks, which is saying something.
Yeah.
But there have been other times when people have bought treasuries and they've been a terrible investment. The late 30s was a time you did not want to buy treasuries because you got there was price suppression. There was interest rate suppression and inflation during
Sure.
the Second World War.
Yeah.
And again, you didn't want to buy them in the 1950s. You got hosed in the 60s and 70s. So
Yeah.
it's fluctuated. The situation. So I'm spending a lot of time talking about this very obscure interest rate, but the interesting thing about it is it's the single most important interest rate for anyone in retirement.
Yeah.
Because
Yeah, that's
essentially, if you are retired, I mean, simplifying somewhat, you save your money when you're working and then you draw down your savings when you're retired. I mean, it's not quite that simple. You don't have 100% in stocks while you're working and then suddenly go to 100% bonds. But
Right.
nonetheless, when you are retired, you are looking for lower risk, guaranteed returns to match inflation, and for that, tips are unmatched.
They're
And they
unmatched
have-
right now. Yeah.
there's no asset like them. And the fact that they are now very cheap, they're very cheap. To be honest, they're very cheap. They're not at the point. A handful of occasions in my life, I've seen assets in the one-way bet zone. The situation where it's like, this is so obvious, you could just basically go long or short with leverage,
Right.
and guaranteed to make money.
I actually wonder if a 10-year TIPS or whatever is close to a 10-year TIPS bond right now will beat the S&P 500 for the next decade. You mentioned buying the 4-year to ride out a Trump administration if you don't like Donald Trump, but I wonder if over the next decade TIPS actually beat the S&P 500, given how richly it seems to be priced.
Well, this is the thing. I keep going on about this. The biggest threat facing investors, not just retirees, but all of us saving for retirement, is not a crash, a slump, the turmoil we saw even in 2000 to 2003 or 2008 or during the COVID crash or even 2022. Short-term crashes are actually opportunities. The real threat, the real danger is the lost decade. That is when essentially stocks go sideways or down for 10 years or longer.
Which they did from 2000 through 2009.
Yeah. But what's very interesting, at least in that case, there was a crash and then there was a rally and then, of course, there was another crash.
Yeah.
If the worst case scenario was, I think, from 1966 to 1982, the Dow Jones Industrial Average went nowhere in nominal terms. Now, in purchasing power terms, you lost, I think, something like, it may even be 2/3. You lost a ton of money. You went, not only did you not get any positive return over 15 years, you lost ground. Now, if you think about that and you think about the real world, you think about people saving for retirement, you think about people saving for college, 15 years is a lifetime. I mean, you start out, you're in your peak earning years in your 40s, in the 1960s. By the time you are in your 60s and you're near retirement in the early 80s, you are poorer than when you were in your 40s. Now, the fact that there's a bull market that over the next 15, 17 years is of limited use to you because you're near retirement.
Right.
The lost decade is the biggest single danger facing any individual investor. And this is why two things I own, and I think I sort of basically based upon that theory are TIPS bonds and resource stocks. You and I have talked about both of these. I'll go very briefly into resource stocks, which is simply I have a small allocation because I've noticed that on the periods of time when stocks and bonds all do badly, like 2022 or the 1970s, oil stocks, metal mining stocks, and so forth seem to do very well. It seems to be when the cost of resources goes through the roof, that's when stocks and bonds both do badly. So I have some allocation to that. But the more simple thing is TIPS bonds. If you have TIPS, if you have a 10%, if you have a 10-year TIPS bond or 8-year, you are guaranteed to make at least some money.
Right.
That reduces the risk of a lost decade. And,
that's right.
Of course, it'll pay coupons every year, and those coupons you can then use to rebalance and buy more stocks at lower prices during the lost decade. But essentially, if you don't have any TIPS bonds, if you are just in stocks, particularly if you are just in the S&P 500, which at this point is dominated by about 7 high-tech stocks, you are you're breaking the first rule of finance, which is you're not diversified.
You're right, that's right.
First of all, you're actually not diversified. As I said, you're not diversified by stocks because most of your money's in a handful of highly correlated tech stocks, which are all very expensive. But also, first of all, you've got too much stock-specific risk. Second of all, you're all in the U.S. and you're all in dollars, and I know yes, they earn money from overseas, but all the rest of it. So you don't have any international stock exposure, and then you're all in stocks. I'm fascinated by the number of people who, it really, having been through this now since the 90s, it may just reflect the fact that I'm getting old and cranky, but once again, the way people are talking now reminds me so much of the late 1990s.
Yeah.
Why? I remember in the late 1990s when Coca-Cola, I remember famously, Coca-Cola stock, I think, traded on 45 times future earnings.
Yeah.
And it had gone up and up and up and up. And people were saying, why would you own anything other than Coca-Cola stock? Why would you want to own anything? It was like, what's wrong? You've been wrong. And of course, it then halved. And Warren Buffett apologized for having held on to it. He says, after it tanked, he wrote I think in 2002 a mea culpa in his annual report, and he says people ask me what the hell were you thinking holding on to Coca-Cola stock when it was 45 times earnings, and to be honest, I still don't know. I don't know what the hell I was thinking. So, now it's like, why would you own anything other than Nvidia?
Right.
I mean, there is more money now invested. It's a little bit of a false analogy, but there's more money being invested on a daily basis in these ETFs that give you 2x Nvidia than total immediate annuity sales for the whole country. I mean, the total immediate annuities, income annuities, which are basically converts a pile of cash into a pension for life.
Sure.
Those, the total sales are like 10 billion a year.
Yeah.
The amount that's in the 2x Nvidia ETF is 8 billion.
Yeah.
And then you go, and it's like, wait, so let me get this straight. So this is for people for whom Nvidia itself is not risky enough. Right. It's like, I
they need
2x.
2 times.
I mean, this is like, wasn't this what, this is how people got out with crack cocaine. It was like cocaine didn't give them enough of a buzz. They had to basically purify it down to crack.
Right.
This is basically crack cocaine. It's like Nvidia isn't enough for me.
Yeah.
MicroStrategy isn't enough for me. I need 2x.
Right.
I need 2x micro, and then I want to buy it with leverage. I want to buy option. I want to buy options on. I want to buy out of the money call options. It's like, and it's just, I remember the late 1990s, and I have lived through. One of the things I've noticed is I've lived through having 25 years of this. The number of times there has been an absolute consensus about something, and it has almost always proven to be wrong. So the late 1990s, it was growth stocks, and then it was the dot-com bubble. And the dot-com bubble was so insane, I really don't think we'll ever see anything like it ever again. It was just, it was one of those things, it's like you're living through history, and the anecdotes I'll tell you, I mean, companies being valued at multiples of headcount, I mean, because they didn't have a product, they didn't have a website. I mean, but I also remember around that time, 2001, the consensus was that gold was worthless. Yeah. Gold was $250 an ounce, and nobody wanted it. I remember I was in London, and I called around trying to find gold analysts. Yeah. They'd all been laid off. There were a few people left. Yeah. Their entire job was to help gold miners like Newmont and Barrick hedge their portfolio. Yeah. So essentially they, and they didn't actually have any value. They basically said, sell 6 months future, sell whatever. Yeah. So that was basically, and I found a few of them online, and they all told me gold was a sell, even at $250 an ounce. Yeah. It was going below 100. It was worthless. Nobody wanted it. Now what is it, 2,500? And, of course, then 10 years later, Donald Trump was recommending it at $2,000 an ounce, which, of course, was the peak of the market. Right. In 2009, 2010, it was the BRICS. Yeah. Brazil, Russia, India, and China. You had to own as much emerging market as you wanted. Emerging wasn't even enough. You wanted frontier markets. That's right. Emerging. One of the signs you should get out of emerging. You should sell your emerging market stocks. Is when the press start writing articles about frontier markets, saying, emerging markets have now quadrupled. Now you want Peru. Now you want the Philippines.
Now you want the least developed markets possible.
Now you want now you want to invest in the Tonga stock market. And that's when journalists are writing, now is the time to go even further out on the risk profile. You want frontier markets. That's the time to go short of emerging markets. That was a consensus, and of course that turned out to be a disaster. Russia has gone to zero. China's been a disaster. India is up. Recently it was actually a very expensive market at this point. Although to be fair, I haven't followed it closely, so I just report what I hear. But every time there's a consensus, it ends up being wrong. I mean, there must be some consensuses that were right, but I remember I bought a condo in Miami Beach in 2010, I think. It's finished. Miami's finished. Yeah. It'll never grow again. So of course I sold too early, but there we go. so there's always a consensus. And right now, it's very, very hard to argue with the hypothesis that we're in the middle of a total mania. It's
the term from behavioral finance called recency bias keeps coming into my head. I think you mentioned gold. You mentioned gold was left for dead in 2000. Another asset class that I can recall being left for dead was REITs back then. I think some of them were trading with yields of 8 or 9%, and nobody wanted. Real estate seemed ridiculous compared to tech stocks, which were going to change the world.
Let me tell you something. And I don't. This will make me sound smarter than I am. It's better to be lucky than to be smart. Yeah. I had a whole bunch of tech stocks in the late 90s. I essentially, because I was young and stupid, I took risks that I should never have taken. I took insane risks, and it happened that I was lucky. I mean, I put everything I had in a number of stocks that went up like five-fold. So anyway, in early 2000, February 2000, I went to a colleague. I was at the Daily Mail, and I said, I want to write a story about all these value stocks. I said, tobacco stocks they've collapsed since in the start of 2000. The final stage of the dot-com bubble was that everybody dumped their old economy stocks, and they collapsed. And you had tobacco stocks trading on a PE of 5 with a dividend yield of 10%. Companies like British American Tobacco. Yeah. You had brewers, pub operators, and so on. Yeah. And I went to this guy. I said, I want to do a column on this. And he said, no, you're wrong. They're going to keep falling. I said, how can they? It's down to PE of 5. Yeah. I said, where do you think it's going to? So anyway, I said, all right, well, if I won't let me write about it. I was living in Europe at the time, which meant I got very long vacations. And I was going away for yet another 3-week vacation to the Caribbean. Yeah. And I went to the Caribbean. And the first day I was there, I called up my bank. And I had already sold most of my technology stocks. Yeah. Too early, but I'd sold them. I made a lot of money. And I bought a whole bunch of tobacco stocks and pub stocks. Yeah. And, 2 months later, they had gone up like 50%. And then, like an idiot, I took my profits, which I should not have done. Had I just kept my tobacco stocks, I would be retired right now. Right. But it was I don't want this to sound like I'm saying how smart I am. I was lucky. But the thing is, they were left for dead, and people will come up with rationalizations for prices. People don't start by looking at the price, by working out what something's worth and then finding the price. They go the other way. They look at the price and say, oh, well, that must be right because of X. And
that's right.
Probably the most successful investor I've ever known, Alan Meacham, who ran a brilliant long-only fund, young guy.
In Utah, right?
Years. Utah, yeah. He basically didn't even look at stock price, valuation, didn't even start to do a spreadsheet until he'd done all his other work on the stock first. That was the last thing. And he basically, once he was convinced that a particular company was going to be growing its business profitably for 10, 20, 30 years, then he would do his spreadsheet, and then he'd look at the price. And so, if his spreadsheet said, look, this stock should be, worth, $75, and actually it was $12, he'd buy it. He didn't start by saying, and what is interesting, people look at prices and they say, oh, that must be right because, and so, if Nvidia is worth what it is genuinely priced at today, why was it priced at so much less a year ago?
Right.
Or even less than that 2 years ago. Yeah. Robert Shiller, who won the Nobel Prize for economics, mind you. The Nobel Prize for economics shouldn't even exist, but there we go. Robert Shiller basically, he worked out, and his foundational analysis was that stock prices are way more volatile than they should be, that actually the dividends, the corporate earnings and payouts fluctuate much less than stock prices. And that essentially you can mathematically prove that stock prices are irrational. Now, if your listeners have not done so, they should go online and find the latest article written by Cliff Asness at AQR. He has just done and we wrote about it at MarketWatch, he's just done a paper, a tongue-in-cheek look back from a fund manager looking back from 2035. So he's basically predicting the next 10 years, and it is laugh out loud funny. Yeah. But it is, at heart, it is essentially saying, what on earth are people doing speculating on Bitcoin, which has no intrinsic value,
Yeah.
and these S&P 500 mega caps at ludicrously large valuations.
Yeah.
You know, there is ultimately a good company can be a bad stock, and vice versa, because you can pay too much.
Yeah, you can pay too much, yeah.
And, you know, the assumptions that have to go into justifying these prices, these valuations, is in some cases heroic.
Yeah.
But everyone's in them, and I just, you know, this is not a Cliff's article is brilliant, and it is very, very funny, and it is everyone will enjoy. I mean, I was sending quotes from it to people. It's just absolutely brilliant.
I haven't read it yet. I look forward to it.
But he satirizes the mood at the moment, which is that at this point, people are asking, why would you even bother investing in international stocks?
Right.
Why would you even bother investing, you know, in something other than the S&P 500? I mean, exactly the kind of crazy stuff that, you know, you would. It really makes me think of the late 90s and other periods, the BRICS and all the rest of it, when people are essentially saying, why would you even bother? Why would, and it's like, look, why would you bother owning gold? Why would you bother, you know? And it was, so it's fascinating. It is absolutely extraordinary to me. I can't, you know, even if this is a mania, I don't know where it ends.
Yeah.
As I remember from the dot-com bubble, you made the most money right at the end.
Yeah.
I mean, I remember there was one British tech company I bought for 50 pence a share, 50 British pence a share, and 55 pence a share. And it went up to 250 pence, so fivefold, or 400%, and I sold. I thought, this is crazy. It then went up to 450. I think a year later it had gone bust or something. But you know, and it was like, you know, I remember my grandmother. My grandmother came to me at Christmas time. She had shares in British Telecom, and they had gone up from £1 to £2 to £7.50. And she said, "What should I do?" And I said, "Well, I'd sell if I were you."
Yeah.
So they went up. So she sold at £7.50. And then when I saw her for her birthday in February, she was very annoyed because they'd gone up to £15.
Yeah.
9 months later, they were down to £2.
Yeah.
So you make the most money in a bubble right at the end.
Yeah.
And my late friend Dan Bunting used to say, you'll make the most money from the worst stocks. And I'm sure he's right. So the truth is, people have made a fortune on Bitcoin. They made a fortune on NVIDIA. They made a fortune on this stuff. You can be too smart for this game if you've been stupid enough to put all your money in Bitcoin and NVIDIA. You've made an absolute fortune. But at some point, they will sort the wheat from the chaff. At some point, you will, and it actually won't happen overnight. It doesn't. These things don't collapse overnight. What happens is they collapse in stages, and
in the tech bubble, it took 2 years, at least 3 years, maybe, from 2000 through 2002.
What happens is that when the market starts down, a lot of people don't think it's going to keep going, and they treat it as an investment, not as a trade, or they say, "I'll sell when it gets back to where I am," and they just hold on, or they double down. They dollar cost average down. I had somebody calling me up saying, "Oh, I'm dollar," and I was like, "Oh no," and that's the road to the
as you told me recently, don't confuse an investment for a trade.
My friend, the late Peter Bennett, a great guru and in private client investment manager in London, used to say, "Brett, never confuse a trade and an investment. There's nothing wrong with trading, but just remember, you know, you're buying, you know, crapcoin.com because you're going to sell it for a profit in a month. You know, if it goes down, don't say, "Oh, I'll hang on," because it's probably going to zero. Get out. It's not an investment. Investment is something totally different. So we're probably in a trading environment at this point. I do remember the dot-com bubble. Everyone thought it was going to be over by Christmas. It ran until the first week of March 2000. There was the final blow-off stage. I don't know whether the calendar will be the same. What was interesting, pure coincidence, is that the dot-com bubble peaked on March 6, 2000, and the bear market, the 2008 financial crisis, bottomed out on March 6, 2009. I have no idea why it was on the same day, but anyway, who knows? Maybe it'll be March, the Ides of March.
Yeah.
Anyway,
So along these lines of being suspicious of manias and what everyone is interested in, you have a series of columns that where you've made up a hedge fund called Pariah Capital.
Oh, yeah.
Where you buy what the a bunch of managers surveyed by Bank of America dislike the most, and that's done extraordinarily well.
Yeah, although I mean it was it had another good year last year. It wasn't as good as previous years.
Yeah.
It essentially you're going against the consensus, and the reason for this is because what people forget is that because prices are so liquid, the price of a security reflects the supply and demand in the market, and the underlying value of a security does not. So when everybody wants a security, the price goes up. That doesn't necessarily mean the value goes up. So essentially, if people are out of something, and the perfect example of this was gold in 2000, 2001. If everybody is out, nobody has any interest in something. Not only are they not, they've either dumped it or they don't even want to talk about it. Right. That's when you buy. And Pariah Capital is just every year we look at them, and at the moment, I'm waiting for the next Bank of America fund manager survey to do an update. But money managers have been out of commodities and out of bonds, for example, and those are basically. I would be surprised if those don't end up outperforming, because they're so unpopular and they've fallen so far. Yeah. It's a funny thing, because everybody basically is chasing everybody else. And look, the fund managers are rational. They are trying to maximize their own careers, not your wealth. Sure. They're looking after their wealth, not your wealth. They're trying to put their kids through college, not your kids through college. Yeah. Your kids come second. And so they don't want to be wrong in isolation. They don't want to look like an idiot by buying gold at $250 an ounce when everybody is saying, why would you bother buying gold at $200? What the hell's wrong with you? It's going to zero. It's going to $10 or whatever. It is much better to be wrong with the crowd.
With everyone else,
Yeah, than to be right individually. Yeah. And, so at the moment, that is why everybody's in these mega, what are they called?
The Magnificent Seven.
The Magnificent Seven, that's it. Thank you. The Mag 7.
The Mag 7.
Mag 7, not MAGA, Mag 7. Everybody's in Mag 7.
Yeah.
And
some version of it, certainly.
One of Peter Bennett's best lines, he used to say to me, be wary of any investment that fund managers are bragging to each other about on the golf course. Yeah. So they're on the golf course and they're saying, "Oh, we're making so much money in our, Nvidia stock. We're making so much money on whatever." When fund managers are bragging about it on the golf course, run a mile.
That's the warning sign. Yeah.
Another one is when you get tips from people who know nothing about the market. I do remember in February of 2000, I had lunch with an old school friend. She knew absolutely nothing about finance whatsoever. I don't think she knew much about anything, to be honest. She came from a very posh family, wealthy family. She wasn't necessarily the sharpest tool in the shed. And she started telling me about the tech stocks she was buying. And it was like some tech stock in Ireland. And it's like, oh, yeah. And I'm like, and it reminds me of Peter Lynch, who says that there are basically three phases to the stock market. He says, in a bear market or at the very beginning of a bull market, I go to a party and I stand by the punch bowl and people say, "Oh, what do you do for a living?" And he says, "I'm a money manager." Yeah. And they go, "Oh, fine," and then they basically run away. And they have no interest in talking to him.
Nobody wants to talk to him. Yeah.
Then in the middle of a bull market, he says, I say I'm a money manager, and people say, "Oh, that's interesting," and they're willing to talk. He said, at the end of the bull market, right at the peak, he says, People say, what do you do for a living? He says, oh, I'm a money manager. They start telling me what stocks to buy.
Right.
That's the peak of the mania. When people say, oh, no, you've got to get into this. You've got to get into that. So when people who know nothing whatsoever about finance are giving you financial tips, I don't know. I mean, it's very difficult because there is, I wonder if I will ever see a bear market in any asset to compare with the bear market in gold in 2001.
Yeah.
And I wonder if I'll ever see a bull market, a mania, as crazy as the dot-com bubble in early 2000.
Yeah.
When I remember meeting a guy. This would be in February of 2000, and he was some kid, and he was running some company that had no product and no assets, and it was going to, enable, I think it was going to rent office space to dot-coms. It was one of these, the picks and shovels. So it was basically, It was vaporware. There was no company, there was no assets, whatever, and it had some ridiculous valuation, And I met him for a coffee near Liverpool Street Station in London, and he left. He had to go for lunch with the Financial Times.
Yeah.
And he was seeing them, 6 blocks away.
Yeah.
And he left the coffee shop and he got into a limousine that had been waiting there. And I thought, this isn't. he's 28. There's no reason why he can't walk 6 blocks.
Right.
Why? I mean, literally a liveried guy comes out. The guy has a cap and it's like something out of Trading Places. Come on, Mr. Duke. Yeah. And I'm like, this is nuts. This guy has no, and it was absolutely just. If you didn't live through it,
It's hard to imagine if you didn't live through it. Yes.
Yeah. So in a sense, when the financial crisis happened in 2008, 2009, I didn't turn as bullish as I should have done, because I think I was waiting for the kind of bear market you saw in gold in 2001, when no one was even talking about stocks. Why are you even talking about the stock market? That would be like talking about, talking about the Spice Girls. You're talking about something that was hot 30 years ago. And
I can also remember thinking, this can't be the bottom. We don't have people running around saying, I'll never own a stock again. I was really waiting for that kind of moment in 2009, but you're right, it didn't happen.
It's very interesting. I did actually bump into an old friend, a McKinsey friend, who actually had, he said in 2010, he said, I don't own stocks anymore. I'll tell you what is interesting, and for one of the half a dozen columns that I meant to write and didn't write for various reasons. I was working on a book and things got in the way. The bottom of the market was the Jim Cramer takedown on Jon Stewart. And that was the moment that is financial historians will call revulsion, the point where people are absolutely just disgusted by finance. And when Jim Cramer went on, and he basically had to apologize for ever having recommended stocks.
Right.
That was actually the bottom of the market. That day. If you watched that interview and you just went out and bought, the S&P 500 with leverage, you're rich.
Yeah.
And it was, by a lot of measures, the market did not get down. It never got to where it was in the early 80s. It never got to where it was in the 30s. There was a guy called Russell Napier who is a financial historian, and he essentially wrote about the great bear market bottoms in history. And he thought another one
The Anatomy of the Bear is his book.
Yes,
is his big book. Yeah.
And it was 1921, 1932, 80, was it 1981, 1974? I don't know, I can't remember. There may have been a fourth one. But anyway, we never got down to those sort of levels.
Yeah, that's right.
So if you're expecting that, you could end up missing, being underinvested. You're sitting there waiting.
That's right.
This is what happened to John Hussman. He was waiting for the 1931-32 moment when the stocks that have gone down 50% then go down another 80%.
Right.
And it never happened. Equally, if I look at the market, the mania today, and I say, well, it's not like it was in February 2000. Mm-hmm. It's not, it's not as crazy as then. Maybe it is, but I just don't know because I'm not young and stupid. I'm old and stupid, and there's a big difference. So, Maybe I'm just not into it. I mean, in 2020 to 21, the mania for NFTs was a classic .com. The NFTs have zero value. There is no
Right.
that is as if I basically picked up these pair of reading glasses I got from Amazon for $10, and I put them on the market for $1 million,
Right.
and the bidding went up to $3 million. It's like, it makes no sense. And if you go back and read what Mark Cuban wrote in defense of these NFTs at the time, it was so fundamentally dishonest. It's absolutely just, you read it and you go, really? You are just, anyway. So maybe if I'm waiting for that 2000 moment before saying, get out of stocks, maybe maybe it won't happen. I don't know. So I can't say we're right at the peak, and I'm not saying it's not going to. It's very interesting, but I'm just saying it is. I mean, I'm a naturally cautious person, and I accept that. So I'm always skeptical of consensuses. But at the moment, I look at stuff, particularly these Mag 7, and I just think, this is, everybody's in this, everybody's bullish, and not only is everybody is essentially, if you make anything, I got an angry email from somebody a while ago, criticizing me and Jason Zweig, and basically saying, oh, Jason Zweig has been telling people to keep some cash, in their portfolio for years, and it's like, what's wrong with that? And it's like the idea. I mean, he's basically the idea that it's stupid to keep any cash. The idea that anyone who's not 100% equities is a fool. Is exactly the kind of thinking you get only at certain peaks. And you can't really have an equity risk premium when the people buying stocks think there's no risk. If they say there's no risk, then why would there be an equity risk premium? They'll pay any price. They'll pay any price.
Yeah.
And you and I have talked about a book. I actually haven't read it. An old school friend put me onto it. A book called Number Go Up. And essentially, it's about crypto bros.
That's right.
It's essentially recency bias.
Yeah.
Disconnected from any. So it's like, look, this must be good because the number's gone up.
Because the number's going up, right?
Yeah. And it is. There we go.
Let's shift gears for a second, Brett. In the little bit of time we've got left, you also write a lot about health, mindfulness, both mental and physical health. You write a lot about how to keep yourself healthy. Talk about that a little bit. What gets you interested in that? I mean, aside from the fact that we're all interested in living longer and staying healthy.
There's a lot of demand from readers. Readers want to know more about healthy aging, because I write about retirement and write about aging. Healthy aging is a very important issue, and there are any number of breakthroughs. I've had family experience of dementia. I'm sure everyone's had family experience of dementia, and so I've been very, very interested in developments on the dementia front, both in terms of things we can do to minimize our risk, but also looking at pharmaceutical developments to find cures. This is one reason why I am very much a dissenter from this liberal media consensus that pharmaceutical companies are bad and it's like, no, as far as I'm concerned, they should be making more money, because I want, we are spending money upgrading iPhones that could be spent trying to find, wait until a loved one gets a terminal illness and you say, why isn't there a cure for this already? Then you'll say, gosh, maybe if we'd been pouring money into this rather than, 5G, we'd be fast getting there quicker. So it's an obsession of mine. But in terms of health, I mean, I was just noticing there's a research came out that said taxi drivers and ambulance drivers have considerably lower incidence of dementia. And they are, of course, pathfinding all the time. They're always navigating. And there's a lot of research about pathfinding and the human brain and memory. The human beings, our brains are designed to remember paths. We're not designed to remember, lists or numbers or facts. We're designed to remember our way through the jungle. And by landmarks. And that's why memory tricks like memory palaces and so forth were created to essentially convert things you need to remember, your shopping list or whatever, into images, visual images that your brain will remember more easily, because our brain is designed to remember our way to the water hole, or remember our way to where the woolly mammoths are.
Sure.
Excuse me, I'm still fighting off a cough.
Yeah.
So it's interesting that people who have to exercise that part of their brain all the time have a lower incidence of dementia. And it does raise an obvious question, which is that if we are all now relying on GPS and Google Maps,
Yeah.
is that part of our brain going to atrophy? Is that an issue that we should address? Should we basically leave the Google Maps at home or rely on it much less often?
Yeah.
Other things about healthy aging, particularly with the brain, include, of course, things like the Mediterranean diet. There's a whole bunch of things, obviously kale and berries and nuts and so forth. Walking,
You've written
exercise,
about coffee and
coffee.
Yeah.
One of the things that is a subject increasingly close to my heart, and I know you and I have discussed it offline, is mindfulness and mindful meditation.
Yeah.
I can't remember many books that have had as profound an impact upon my thinking as Eckhart Tolle's The Power of Now.
Yeah.
Which
You're
is
not
a
the only one to
foundation-
say that to me. Yeah.
A foundational book about mindfulness. Now, some of it's spiritual and mystical, and that you can take that or leave it. But
Yeah.
what I found very interesting, and I had already done a mindfulness course at the University of Massachusetts, and I had done various online mindfulness courses. But when I read this book, it really made me think about mindfulness and being in the moment in a very philosophical way, which I had not before, and it's very interesting. I've read it and reread it, and the audiobook is fantastic. And I've probably listened to that audiobook 20 times. And
Wow.
it is very interesting because mindful meditation and some mindful chanting has been found to have, found is probably too strong, it's strongly suggested it has healthy effects on your brain.
Yeah.
That this is something that people can and should embrace for healthy aging purposes as well as everything else.
Yeah.
And that's a major factor for why I do it. And it's, but healthy aging there's an enormous demand from MarketWatch readers for the latest news, and I keep abreast of the scientific developments. I'm not a scientist. I don't pretend to be a scientist.
Yeah.
Which is probably fortunate because the scientists don't seem to be able to write English. Same as economists. I read this stuff and I go, wow, nobody taught you it's interesting. Writing.
Yeah.
Anyway, there we go. So I have to translate these stuff into English, which is probably helpful for people.
Yeah. Yeah. Well, very good, Brett. This has been a wonderful discussion. Thank you so much for coming on. I appreciate it.
My pleasure being here.
I look forward to the next article on Pariah Capital when you when the next Bank of America survey comes out, and you come up with the most disliked investments and of course tout them.
Yeah. Well, that'll be good. So John, look, thank you very much for having me on. Great to talk to you anytime. Sorry about the camera.
That's okay. Thanks so much, Brett. I appreciate it. Take care.
Bye.
This is John Camorianos for Capital Considered. Thank you for watching and listening. Look forward to seeing you on the next episode. Please like and subscribe. Thank you.